Welcome to today's case interview. Have you ever woken up just to find that your favorite stock dropped by 20% overnight? Inspired by the events in late September 2025, after DeFi Technologies' sharp drop right before the anticipated crypto rally, let's explore a new perspective on market dynamics in case interviews for strategy consulting. Now, this isn't just another market sizing case. It's a fresh perspective that exemplifies how strategy consultants abstract away complexity to push decisions forward. It's a hybrid between McKinsey's interviewer-led and most other strategy consultancy's candidate-led styles. And unlike in many other mock interviews, I will also show you how interviewers intervene to keep the story going when candidates get stuck. This case study investigates the market repricing of DeFi platforms to test candidates' structuring, quantitative reasoning, and business judgment. It's been designed for 35 minutes, thus following the standard 1-hour format of 15 minutes of getting to know each other first, then 45 minutes of case interview, and finally 10 minutes for you to ask any questions. So first we got a short intro to DeFi platforms' business lines. Then we got 3 questions, including a short sensitivity, before we wrap up the case. Throughout the case, we will test the candidate's ability to diagnose, structure, prioritize, reason quantitatively, apply logic and aggregation, interpret, synthesize, and show business sense. Let's jump right in. DeFi platforms' 3 business lines democratize access to crypto exposure, monetize spreads across exchanges, and compound digital assets appreciation. The exchange-traded products, or ETP business line, adapts the idea of ETFs from stocks to crypto coins. This means customers can buy exposure to crypto without needing a wallet, which is a technical entry barrier for customers that are not tech-savvy. The arbitrage trading desk monetizes bid-ask spreads across crypto exchanges, thereby generating consistent low-risk returns. And the digital asset treasury holds DeFi platforms crypto coins such as Bitcoin and Ethereum. This adds upside when the coins appreciate in value. So recently, DeFi platforms experienced a sharp drop in stock price, and we wonder why. On the left, we can see how DeFi platform stock price developed over the last month. It's been going up with a short correction that's been reversed quite fast and then suddenly plummeted to the ground again, erasing all monthly gains. Specifically, it dropped from $265 down to $216. So here comes the first case question. What could have caused the stock price to drop so sharply in late September? Just a quick brainstorm, no more than 5 minutes in total. Note here that the interviewer is timeboxing this question right from the beginning, and for you it's time to pause the video and work on this first prompt. Alright, so let's see how we could approach this first prompt. First of all, you should ask some clarifying questions, as there are many reasons why a stock can drop sharply, and this helps you tailor your answer to the specific case at hand. In this case study, let's assume the interviewer just lets you know that only DeFi platform stock dropped today, all the other crypto stocks and coins show positive momentum, and he really isn't sure what the problem with DeFi platforms is. Now let's have a look at one way to address the prompt. For this, let's map out the option space to ideate and prioritize root causes. So here I propose to investigate this from a market perspective. The macro environment is the base layer. Inside that layer, let's look at supply, intermediation, and demand, or for 4 DeFi platform shares. In the supply category, we have the broader crypto industry and DeFi platforms in particular. For intermediation, I suggest we look at analysts and market makers, exchanges, brokers, and so on, and let's just shorthand refer to those as market makers. For the demand side, let's break this down into institutional and retail-driven demand. As just clarified, the dip must have been caused by a company-specific event, so we should neglect macro-environmental and industry-specific root causes right from the beginning. From the supply end, DeFi platforms could have caused a dip by one of the following 4 reasons: financials, financing, management uncertainty, or insider sell-offs. Let's look into each of them. Financials, that is, missing a sales or earnings target in their quarterly report or lowering forward guidance. Financing, that is, announcing a capital raise, diluting existing shareholders, especially if it's not oversubscribed and without a lead investor, management uncertainty, such as their CEO stepping down with no immediate successor, or repeated significant insider sell-offs. From the intermediation layer, analysts could have caused a dip by re-rating DeFi platforms and or lowering its target price. While market makers and exchanges sit in between supply and demand as well, their role is more subtle and they usually don't cause such large dips, or that would be quite concerning if they did. From a demand end, institutions could have caused a dip by a sell the news event, that is, selling off a large portion of their position in DeFi platforms after they reached a major milestone such as a Nasdaq listing. Retail finally theoretically could have sold off as well for some reason. So let's prioritize this. From a prioritized perspective, I guess it's most likely that either weak financials or a capital raise as company internal events caused a dip, or that institutions performed a sell and news sell-off. Management uncertainty, a significant insider sell-off, or a re-rating by analysts are possible, though less likely. Market makers or exchanges in retail most likely did not cause the dip, as market makers and exchanges play a much more subtle role in market dynamics, and retail is usually who is getting dumped on, not the ones dumping, as they actually have a significant information processing and order execution disadvantage. As it turns out, this dip was caused by the announcement of a capital raise of up to $190 million. So right before the dip, DeFi Platforms announced it had entered into a purchase agreement comprising the sale of 45 million units. Each unit is priced at $219 and comprises 1 share and 3/4 of a warrant. Each warrant can be turned into a share for $263. So simply put, if you buy 4 units, that gives you 4 shares immediately, and the right but not the obligation to buy 3 more shares when exercising the warrants, which is 3 warrants here, but you have to pay those $363 per warrant that you exercise to turn into a share. So the warrants do not give you free shares, that's really important. You have to pay when you exercise a warrant to get another share. So here in the example, you could get at least 4 and at most 7 shares when buying 4 units. Now on the right we can see that in the capital raise, in total 45.6 million shares and 34 million warrants were sold. At $219 per share, this corresponds to $100 million raised from the shares immediately, and at $263 for each warrant share redemption, this corresponds to up to another $90 million. So in total, at least $100 million and at most $190 million were raised in the capital raise. Let's see if the sharp drop that we see here on the left again was justified though. And that leads us to the next question for you. What's the fair price of the stock after the capital raise, assuming all warrants have been exercised immediately? So as you can see on the left, DeFi Platforms currently trades at $216. Before it fell off the cliff, it even traded at $265. So for you, it's now time to pause the video again and I'll be right back. So first things first, you should have developed a structure for calculating the fair stock price by now, and while doing so have noted that you're missing a central piece of information, and that's the number of shares outstanding before the capital raise. So of course the interviewer can readily provide you with this info. It's 350.6 million shares outstanding before the capital raise, so we can get right started. First, we need to calculate the average share price investors paid in the capital raise, assuming all warrants have been exercised immediately. This initial step can be broken down into 3 sub-steps. First, we need the total capital raised from the penultimate slide, which is $190 million. Alternatively, we could just multiply the number of shares sold, so those 45.7 million, with the unit price of $219, and add the number of shares that can be purchased from the warrants multiplied by the exercise price of $263, and that gives us just these $190 million. Second, we need to calculate the total number of shares issued, assuming all warrants have been exercised, which is just the sum of the shares and the warrants sold in the capital raise. And third, we can divide the total capital raised by the total number of shares issued, and we get those $238 as the average share price and the capital raise, assuming all warrants are exercised immediately. This allows us to blend existing and new buy-in stock price compared with the observed stock price and find the market price overshot by 17% down. So here there are two more steps to follow. First, we should calculate the average share price, and we can do that by multiplying those 350 million shares that already existed by $265, so the share price before the capital raise, and add those 80 million shares that were issued in the capital raise in total, assuming all warrants were exercised immediately at $238 on average. We can divide this by the total number of shares after the capital raise, which is the 351 million shares that we had before the capital raise, plus the 80 million shares that were issued in the capital raise. And this then gives us those $1.1 billion that we need to divide by those 441 million shares, which is $260 a share. Now let's do a short interpretation here. We just found that it would have been fair if stock price dropped by 5 cents, but in fact we observed that it dropped by 49 cents, so from $265 right down to $216 instead of just to $260. And this is actually an absolute value at 10 times overshot. Or if you put this relatively, it's 44 cents divided by $260, which is around 17% lower than expected. This short interpretation at the end is actually very important because your job in a case interview is not just to crunch numbers, but to show business sense all the way. And that's why we need to do this here, even though we weren't asked to do so. There were several news on DeFi platforms in the last few days. Where does this lead us by the end of Q4? So here comes your next question. Starting from the current stock price, what's a fair stock price by the end of the fourth quarter in 2025, based on the news and anything else that might be relevant? As we can see from the chart on the left, recently there were 4 news articles that were published on DeFi platforms, so let's see the next slide for some more background. A fair total impact on stock price of the 4 news is estimated at plus 95 cents. The 4 news are 1. ETP expansion, 2. DeFi partnership, 3. QCAD investment, and 4. The capital raise that we just learned about. At the bottom of the slide, we can see the total fair impact that each news report is estimated to have on DeFi platform stock price. The ETP expansion expands that business line by 9 new ETPs in Sweden and should add another 5 cents to stock price. The DeFi partnership aims to connect the $100 trillion debt market to decentralized finance and is expected to add another 40 cents to the stock price. QCAD is a Canadian stablecoin that is simply speaking just Canadian dollars living on the blockchain, and DeFi platform's investment in QCAD's issue is expected to add another 20 cents to its stock price. And finally, we get a capital raise that we just covered. There is one more thing about it that we didn't mention so far. The capital raise was oversubscribed, which is a good thing because there was more demand than supply for the units sold in the capital raise. And Galaxy Digital, which is an industry leader in the crypto ecosystem, bought most of the units. So all in all, this explains why the capital raise should have a positive net impact on stock price of plus 40 cents rather than dragging it down. Galaxy Digital backing DeFi platforms brings a lot of credibility to the table, far overshooting the mechanical dilution effect of those minus 5 cents. Now it's time again for you to pause the video and start tackling question 3. After around 2 minutes, you should have come up with a structure to estimate fair stock price by the end of the fourth quarter. To estimate fair stock price by the end of the fourth quarter, we adjust current stock price for the news and non-news contributions of the business lines. For the news, we already got all the information needed to work this case question. Beyond the news, we should ask for additional information on each business line to focus the individual contributions to stock price in the fourth quarter. And the simplest way to look at this is to just ask for the forecasted net profits of the business lines and divide these by the number of shares. So for the ETPs and the ATD business, this is pretty straightforward. The digital asset treasury, or DAT, is not a typical business, so we can be a little bit more specific here and point out that we intend to look at its value appreciation. And naturally, this leads to us asking about the number of coins by cryptocurrency that DeFi platforms is currently holding, and if there's any information on the expected trajectory of these coins' prices till the end of the fourth quarter. Note here that this question again is timeboxed to 10 minutes, though less explicitly, and the interviewer certainly doesn't expect you to estimate each business's net profits going forward, as that just would be a separate case of its own for each of the businesses. Thus, let's just say the interviewer hands us the net profit forecasts for the ETPs and the ATD, which is this exhibit here, and for the digital asset treasury or DAT, the interviewer points out that we don't have that, but here's the coins holdings, and we prepared this indicative correlation analysis with Bitcoin's price movement here. So let's do this step by step. First, we have the news. The news are currently priced in at minus 20 cents, but they are valued at plus 95 cents. Thus, the news correction should be plus 115. That's what the action title says, but let me show you how to get there. From the stock price chart, we can deduce that before the news, DeFi platforms was trading around 236. As we learned from the news slide that the news are worth 95 cents in total, it would be fair if DeFi platform was actually trading at 331 now, however. But we're down to 216. That's a 1.15 difference that we should correct for. Now, if a candidate would start separating each news report's impact, which is technically possible in this case, I would step in as the interviewer and ask if that's really necessary to keep this time boxed. Adjusting the current stock price, which is 216, by the news correction of 115 leads us to a subtotal of 331, which we can see on the bottom of the slide. Next, we got a second bucket, net profit per share of the ETP and ATD businesses. For this, we just need to grab the 9.5 million in forecasted net profits for the fourth quarter from exhibit number 2 and divide these by the 431 million post-raise shares, which gives us 2 cents per share. We can now update our previous subtotal and get a stock price target of 333 so far. Finally, we got a third bucket, which is the DAT's value appreciation in Q4. The DAT's Q4 contribution to stock price can be estimated by scaling the expected appreciation of the per share treasury with the treasury's market cap multiple. That's simplified but fair in a case interview. So the idea here is to first calculate how much the crypto coins in the treasury are worth per share, and multiply this with a growth factor for the fourth quarter, which then gives us the DAT's value appreciation per share in the fourth quarter. Now, with this part of the equation, your interviewer will already be very happy. If you're familiar with DATs though, you know that these usually trade at a multiple larger than 1 with regard to their treasury's plain vanilla value. So let's not get into the details of why this is the case here, but in case you're missing the right part of the equation, the interviewer will be willing to help you out here. Here, let's estimate DeFi platform's treasury's market cap multiple based on its historic market cap versus DAT value ratio. Note here that on the left, I'm using the post-raise shares for per share DAT value appreciation to prevent overstating shareholders' exposure to the DAT. But on the right, I'm using the pre-raise multiple for scaling to preserve historic market sensitivity, as sensitivity is not expected to change due to the capital raise. Back on the DAT's exhibit, you should suggest considering the DAT as a whole and not each coin separately to avoid overcomplicating the case. The most straightforward way to do so is to assume the entire treasury consisted of Bitcoin only, as exhibit 3b depicted how DeFi platform stock was moving pretty much in sync with Bitcoin. So as we can see here, DeFi platforms have shown very high correlation with Bitcoin during the last year, with a level break in DeFi platforms around 2 months ago and a decoupling this week. I'd suggest to the interviewer to keep it simple here as well and assume that going forward DeFi platforms and Bitcoin will keep moving in sync, especially as last week's decoupling can clearly be attributed to the announcement of the capital raise. If you're a little familiar with Bitcoin, you probably know that most analysts are quite bullish and expect it to go up by around 60% in the fourth quarter of 2025. If you're not, you can deduce that from the 1-year chart on the left, but generally speaking, any reasonable estimate is fine here. Now we just need to plug in the numbers. On the left, we divide the DAT's current value, the $50 million US, by the 440 million post-raise shares and multiply it with 60%, the growth assumption, which then gives us 7 cents per share in DAT value appreciation for Q4. On the right, we calculate the historic sensitivity as an estimate of future sensitivity and thus go with the 351 million pre-raise shares and the $265 pre-raise share price. We divide the product by the treasury's value and get a market cap multiple of 18.5. Now we just need to multiply the 7 cents with the 18.5, and this gives us $130 in expected DAT Q4 value appreciation. When we add this to the current subtotal of fair stock price of 333, we get our final estimate, which is 336, as the fair stock price of DeFi platforms by the end of Q4 2025. And that's also what we see on this slide by stacking all the blocks together. Current stock price was 216, then we corrected for the news, added ETPs and ATD businesses Q4 contributions, and finally pressed in the DAT's Q4 expected value appreciation. Overall, this yields a fair stock price of DeFi platforms of 463 by the end of the fourth quarter. In case you made it this far, pause for a second. We're not quite done here yet, are we? There's one thing that's missing, and that's the Sanity Check. So for the Sanity Check, I suggest you ask the interviewer for analyst ratings and their target prices 1 year ahead. And of course, the interviewer can readily provide you with this. So here 6 analysts are covering DeFi platforms, and by the end of the third quarter in 2025, their average target price 1 year ahead is $486. So that's not yet considering the news that we saw in this case study. Now to perform the actual Sanity Check, I suggest to follow a 3-step approach. First, let's calculate the quarterly gap going forward in quarters 1 to 3 2026. Second, derive the underlying growth requirements. And third, backtest plausibility of these growth requirements throughout the last year. So let's start with step 1. The target price of the analysts by the end of the third quarter in 2026 is $486 plus those 95 cents from the news that we haven't priced in yet, which gives us $581. Our fair target price estimate for the end of the fourth quarter 2025, however, is only $463. This gives us a gap of $118 that needs to be bridged. Or put differently, in each of the 3 quarters going forward in 2026, we need another 39 cents. We already know from the case that the ETPs and the ATD business contributed 2 cents in the fourth quarter, and we can just assume that this will be the case going forward as well. So this leaves us with 37 cents that the DAT business actually needs to contribute here. For the fourth quarter, we just calculated a contribution of $130. So 37 cents, that's actually just 28% of the Q4 contribution. For Q4, we assumed a growth rate of Bitcoin of 60%. So if we only require 28% of what we saw in the fourth quarter for the DAT's value appreciation, we can adjust the 60% growth assumption for Bitcoin downwards. And this we can just do by multiplying those 28% with the 60%, which gives us 17%, which is the required DAT growth per quarter going forward through quarters 1 through 3 in 2026. Third, let's backtest plausibility. From Exhibit 3b, we know that Bitcoin went up by 70% in the last year. So 70% divided by 4 quarters gives us 17.5% on average. That's a slight overestimate due to compounding. It only needs to go up by 15% or something like that per quarter. But anyway, our required DAT growth per quarter going forward through quarters 1 to 3 in 2026 of 17% is definitely in the ballpark. And thus we can conclude that our estimate of $463 as a target stock price of DeFi platforms by the end of the fourth quarter 2025 is in line with analysts' opinions. One more thing, which stock price did markets implicitly assume for the units sold in the capital raise? So finally we got a short sensitivity question for you. Especially partners like to use these, and you can expect 1 or 2 such small sensitivity questions at the end of the case. Before you answer, you're typically allowed 30 seconds to think. So this creates a bit of an artificial situation as you do not respond immediately like you would do in a normal conversation, but you also don't take 2 or 3 minutes to build a full structure before answering. So here comes your sensitivity question. After the raise, stock price dipped to 216. Which stock price did markets implicitly assume for each unit from the capital raise, assuming all warrants are exercised? Now pause the video again and just take 30 seconds to sketch out what you'd need to calculate here. This time, there's no need for any clarifications. The implicit price of units in the capital raise is simply the difference between DeFi platform's market cap right after and before the capital raise, divided by the maximum number of shares issued in the raise. To get all these numbers, we just need to revisit our calculations from question 2. The market cap right after the capital raise is 431 million shares times $216 a share, which is 930 million US dollars. The market cap before the raise was 351 million shares times $265 a share, which is 929 million US dollars. Assuming all warrants are exercised, we need to divide this delta of just 1 million US dollars by the 80 million shares, which were issued in the capital raise in total, which gives us roughly 2 cents. Thus, in fact, markets assumed shares and warrants had been given away for free in the capital raise. So what's the key takeaway from all this? At the end of the case, it's your job to proactively synthesize what you learned in the case. So what's the conclusion from your analysis? If you've been diluted, don't panic sell. If you're looking for a technical buy-in opportunity, here you go. Market overreacted. Fair value is around 463. Current price is 216, which implies more than 100% in upside. Diluted shareholders should hold. New investors should consider the opportunity to buy in now at a 15 to 20% discount. This case study is not financial advice. Capital at risk. Do not invest unless you can afford to lose 100% of your investment. Last but not least, a short legal disclaimer. This case study simplifies complex patterns in capital markets. It's been designed for interviewing candidates for generalist positions with strategy consultancies. By no means, any of the contents in this case study should be understood as financial advice.